This video content is strictly for informational, educational, and entertainment purposes only. It does not constitute financial, investment, legal, or tax advice. The financial markets, including Forex, foreign exchange, and futures trading, involve a high degree of risk and are not suitable for every investor. There is a substantial risk of loss, and you should not trade with money you cannot afford to lose. The use of leverage can work against you as well as for you, and could result in the loss of your entire investment or even more than your initial deposit depending on the specific brokerage arrangement. Any references to historical price movements or trading scenarios are for illustrative purposes only and do not guarantee future results. The views expressed in this video are personal opinions and should not be interpreted as professional recommendations. We are not licensed financial advisors, commodity trading advisors, CTAs, or registered brokers. Please consult with a qualified, licensed professional before making any financial decisions. You are solely responsible for your own investment decisions and the verification of any information presented here. There is a statistic floating around the financial industry that brokers whisper about in private meetings, but rarely print on their glossy landing pages. It is known as the 90-90-90 rule. It suggests that 90% of retail traders lose 90% of their account balance within their first 90 days of active speculation. This is not just a number. It represents millions of dollars of evaporated wealth, shattered confidence, and the harsh reality of entering a battlefield where you do not even know the rules of engagement. When you click that buy button on your smartphone app, you assume you are participating in a fair, open marketplace. You assume that if the price goes up, you win, and if it goes down, you lose based purely on supply and demand. But what if I told you that the game you are playing changes entirely depending on whether you are trading spot Forex or exchange-traded futures? What if I told you that in one market, you are trading against the house while in the other, you are trading with the market? The distinction between Forex and futures is not merely a choice of ticker symbols or asset classes. It is the difference between an over-the-counter, decentralized network of banks and a centralized, regulated exchange where every single order is recorded on a public tape. Most people clicking into this video today are looking for a simple comparison. You want to know if you should trade the Euro-US dollar pair or the E-mini S&P 500. You want to know which one requires less capital or which one moves faster. We are going to get to that. But if you stop at the surface level, you remain part of that 90% statistic. This is not a 5-minute summary video. This is part 1 of a comprehensive masterclass designed to deconstruct the very plumbing of the global financial markets. We are going to strip away the marketing gimmicks used by offshore brokers and expose the structural reality of how money actually moves around the world. We are going to explore why a hedge fund manager in Connecticut structures a trade differently than a retail scalper in their home office, and why the instrument they choose is often more important than the direction they predict the market will move. The problem you face today is one of information asymmetry. When you enter the world of trading, you are bombarded with advertisements promising financial freedom through Forex trading. You see influencers showing off charts on MetaTrader 4, claiming they made thousands of dollars in minutes catching a move on gold or the British pound. Simultaneously, you hear the serious institutional crowd talking about the DOM, Level 2 data, and the clearinghouse in the futures market. Feels like two different languages because, effectively, it is. The barrier to entry for Forex is incredibly low. Sometimes as little as $50 opens an account. The barrier for futures has historically been higher, creating a psychological gate that keeps many retail traders out. This creates a dangerous ecosystem where the least experienced traders are funneled into the most opaque, complex, and predatory market structure, spot Forex, while the transparent, regulated machinery of the futures market remains a mystery to them. This series is going to solve that problem. We are going to dismantle the confusion. By the end of this deep dive, you will not just know the difference between a pip and a tick. You will understand counterparty risk. You will understand why volume data in Forex is often a mirage, while volume in futures is a concrete fact. You will understand the massive tax implications that separate a Section 988 contract from a Section 1256 contract under the U.S. tax code, a difference that could save you significantly at the end of the year if you are profitable. We are going to walk through the mechanics of a trade from the moment you click the mouse to the moment the cash settles in your account. We are going to examine the concept of centralized clearing versus bilateral agreements. This is about moving you from a mindset of gambling on price movement to a mindset of professional risk management. Let's look at a hypothetical but very realistic scenario to illustrate the stakes here. Imagine a trader named Alex. Alex decides to trade the non-farm payrolls news release. He opens his Forex broker app, sees the euro to US dollar trading at 1.1050, and decides to go long, anticipating a weak jobs report. The news drops, the dollar weakens, and the chart spikes up. Alex is ecstatic. But when he goes to close the trade, or perhaps when his stop loss should have triggered, he notices something strange. His execution price is nowhere near what he saw on the screen. He experienced slippage. Or worse, he sees a massive wick on the candle that only appears on his specific broker's feed, stopping him out before the market rips in his direction. Alex feels cheated. He feels like the broker hunted his stop. In the decentralized world of spot Forex, where there is no central exchange and the broker can often be the counterparty to your trade, these conflicts of interest are inherent to the model. Alex is trading in a dark pool where the liquidity provider holds all the cards. Now, contrast this with a professional trader, Sarah, trading the Euro FX futures on the Chicago Mercantile Exchange, CME. Sarah wants to take the same position based on the same news. She is looking at a depth of market ladder. She sees exactly how many contracts are sitting at the bid and the ask. When she enters her order, it goes to a centralized matching engine in Aurora, Illinois. Her order is matched based on strict price-time priority. If she gets filled, she knows exactly who filled her, or rather, she knows the exchange facilitated it impartially. There is no broker betting against her. The broker in her case is merely a conduit to the exchange. If the market moves, everyone sees the same price. Everyone sees the same volume. The transparency is absolute. Alex is playing poker where the dealer can see his hand. Sarah is playing chess where the board is visible to everyone. This masterclass is going to explore why millions of traders still choose Alex's path despite the risks, and why Sarah's path, while more transparent, comes with its own set of rigid capital requirements and data fees. We are going to look at the why. Why do we have these two parallel systems? It stems from the history of global commerce. Futures were born out of the necessity for farmers to hedge the price of corn and wheat, evolving into the complex financial derivatives we see today for indices and treasuries. Forex was born out of the necessity for international banks to settle payments across borders. Understanding this DNA is crucial. It explains why Forex is a 24-hour, 5-day-a-week continuous flow of liquidity, while futures have strict open and close times with settlement periods. Over the next 9 parts of this series, we will dissect leverage, margin calls, the true cost of carrying a trade overnight, and the regulatory bodies like the NFA and CFTC versus the varied landscape of offshore regulators. But right now, understand this. The choice you make between these two markets dictates your probability of survival. It dictates the tools you have at your disposal. It dictates whether you are analyzing real market sentiment or just a shadow of it. You are about to undergo a complete education on market structure. Forget the easy money promises. Forget the flashy lifestyle marketing. We are about to do the hard work of understanding the business of trading. Welcome to the deep dive. Let us begin by looking at the fundamental architecture of the marketplace. To understand the fundamental architecture of the marketplace, you have to visualize two very different physical spaces, even though today most of this happens via fiber optic cables moving at the speed of light. Imagine the first space. It is a massive fortified fortress. This is the futures market. Specifically, let us picture the Chicago Mercantile Exchange or the CME Group. In this model, everything is centralized. Think of it like a gladiatorial arena where there is only one center stage. Every single participant, whether it is a giant pension fund managing billions of dollars, a massive agricultural corporation hedging the price of wheat, or a retail trader like you sitting in a home office in Ohio, sends their orders to this one specific location. There is no side door. There is no VIP entrance that allows secret pricing. When you buy a contract of the E-mini S&P 500, you are not buying it from a broker. You are buying it through a broker, but the transaction happens on the exchange's central matching engine. This is a critical distinction. The architecture here is built on what is called a central limit order book. Imagine a digital ledger that is visible to everyone simultaneously. On the left side, you have all the buyers and the prices they are willing to pay. On the right side, you have all the sellers and the prices they are willing to accept. When a price matches, a trade occurs. This structure creates something incredibly powerful: a single universal price. At any given millisecond, the price of the S&P 500 futures contract is the exact same for the hedge fund manager as it is for you. There is no ambiguity. If the market says the price is 4,500.50, that is the price. Now erase that image from your mind and picture the second space. The Forex market. This is not a fortress. It is a sprawling, chaotic global bazaar. It is a network of interconnected banks, financial institutions, and retail brokers. There is no central building. There is no single server where all trades are recorded. This is what we call an over-the-counter or OTC market. It is decentralized. When you trade Forex, you are not trading on a central exchange. You are trading within a network. To understand the gravity of this, we need to look at the top of the food chain. This is the interbank market. Imagine a tier of massive global banks, names like JP Morgan, Deutsche Bank, UBS, and Citi. They trade currencies with each other in massive quantities, tens or hundreds of millions of dollars at a time. The price at which Bank A sells euros to Bank B might be slightly different, by a fraction of a pip, than the price Bank C is offering to Bank D. There is no single official price of the euro against the dollar. There is only the best price available to you at your specific level of the network. As a retail trader, you are not typically trading with JP Morgan directly. You are miles downstream. You are trading with a retail broker who has their own liquidity providers. Your broker takes the prices they get from the big banks, adds a markup, which is the spread you pay, and presents that price to you. This means the price you see on your screen might be slightly different from the price your friend sees on their screen if they are using a different broker. In the futures market, that scenario is impossible. In Forex, it is the standard operating procedure. This architectural difference explains why arbitrage, buying at a lower price in one place and selling at a higher price in another, is theoretically possible in Forex but practically impossible for retail traders due to latency and costs. Let us dig deeper into the implications of this centralization versus decentralization, specifically regarding volume. In the futures market, because every trade goes through that single fortress, the exchange can tell you exactly how many contracts were traded at a specific price. This is hard data. If you see that 5,000 contracts were bought at a certain level, that is a fact. Traders use this for volume profile analysis to see where the big money is defending a position. You can see the aggression. In spot Forex, because there is no central exchange, there is no central record of volume. When you turn on a volume indicator on your Forex chart, you are not seeing the total amount of money changing hands globally. That data does not exist because no one entity tracks every trade between every bank in the world. Instead, what you are seeing is tick volume. You are seeing how many times the price changed up or down within a specific candle. It is a proxy. It is an estimation. While there is a correlation, usually when price changes frequently, volume is high, it is not the same as knowing the raw data. You are analyzing shadows on a wall, whereas the futures trader is looking at the object casting the shadow. Now, consider the concept of the counterparty. This is where the architecture becomes a matter of safety and conflict of interest. In the futures market, there is a mechanism called the clearinghouse. When Sarah, our professional trader from the previous example, buys a contract and John, another trader, sells a contract, they are not actually trading with each other directly. The clearinghouse steps in the middle. It becomes the buyer to every seller and the seller to every buyer. This eliminates counterparty risk. If John goes bankrupt tomorrow, Sarah doesn't lose her profit because the clearinghouse guarantees the trade. The clearinghouse is capitalized by the member firms to ensure the integrity of the market. In the retail Forex world, your counterparty is often your broker. This is known as the B-book model. When you buy, your broker sells to you. If you win, your broker loses. If you lose, your broker keeps your money. This creates an inherent conflict of interest. While many regulated brokers operate ethically, the architecture allows for a scenario where the entity providing you with the platform and the data benefits directly from your failure. They might run A-book models where they pass your trade to the larger market, or a hybrid, but you often do not know for sure. In futures, the exchange does not care if you win or lose. They make money on the transaction fees, the commissions, and the data feeds. Their incentive is purely to facilitate volume, not to capture your losses. Let's apply this to a high-stress scenario. Imagine a massive geopolitical event occurs, a surprise election result, or a sudden central bank announcement. Volatility spikes. In the futures market, the central limit order book might thin out. We call this liquidity drying up. You might see the bid and ask prices jump around, but the mechanism remains transparent. You can see the gaps in the ladder. You can see that there are no orders sitting at a certain price level. It is scary, but it is honest. In the Forex market, during that same event, you might experience something different. Your broker might widen the spread aggressively. The difference between the buy and sell price might jump from 1 pip to 20 pips instantly. Why? Because their liquidity providers, those big banks, are pulling their quotes to protect themselves. Your broker, not wanting to take the risk, passes that massive spread on to you. You might try to close a trade and get a requote, or simply get filled at a price far worse than what you clicked. Because the market is decentralized and private, it is very difficult to prove that the fill was unfair. You are playing in a private garden, and the owner of the garden sets the rules during a storm. This leads us to the audit trail. If you ever have a dispute about a trade in futures, you can theoretically trace that order back to the exchange's matching engine. There is a time-stamped record that is regulated and audited. In Forex, especially with offshore brokers, the record is often held internally by the broker. If you claim you hit a profit target but they say the price didn't reach it, you are often relying on their internal logs. It is a classic case of he said, she said. But he owns the platform. So, why would anyone trade Forex if the architecture seems so stacked against the retail participant? Is it just a trap? Not necessarily. The decentralized nature of Forex provides one massive advantage that the rigid, centralized futures market struggles to match: flexibility in contract size. In futures, you are often dealing with standardized large contracts. Even the micro contracts require a specific amount of capital. In Forex, because it is just data and bilateral agreements, brokers can let you trade microlots or even nanolots, allowing you to risk pennies per trade. This accessibility is the double-edged sword that draws millions in. But there is another mechanic, perhaps the most dangerous and misunderstood tool in the trader's arsenal, that varies wildly between these two worlds. It is the reason small accounts can grow rapidly, and the reason they can blow up in a single afternoon. It is the fuel that powers the engine of speculation. We are talking about leverage. And the way leverage is calculated, applied, and regulated in futures versus Forex is night and day. In fact, if you don't understand the difference in how margin is calculated, you could be solvent in one market and bankrupt in the other with the exact same trade size. Leverage is the financial equivalent of handing a teenager the keys to a Ferrari, removing the brakes, and telling them the only way to keep the engine running is to drive faster. In the trading world, leverage is defined as the ability to control a large contract value with a relatively small amount of capital. It is not free money. It is not a gift. It is a loan collateralized by your own cash. And the terms of that loan differ radically depending on whether you are stepping into the Forex arena or the futures arena. If you do not understand these terms, the market will repossess your capital with ruthless efficiency. Let's start with the Forex market, because this is where the concept of leverage is most aggressively marketed and most frequently misunderstood. In the United States, under the regulations of the CFTC and the NFA, the maximum leverage available to retail traders for major currency pairs is capped at 50:1. This was a regulation born out of the ashes of blown accounts. Before this cap, and currently in many offshore jurisdictions, you will see leverage offered at 100:1, 500:1, or even a suicidal 1000:1. What does 50:1 actually mean in practice? It means that to control one standard lot of the euro to US dollar, which represents 100,000 euros, you do not need 100,000 euros. You need approximately 2% of that value in your account as a good faith deposit. If the exchange rate is 1.10, the notional value of that position is $110,000. With 50:1 leverage, your broker locks up roughly $2,200 of your money to hold that trade open. Here is the trap. New traders look at that $2,200 and think, great, I only need $2,200 to play. They forget that they are driving a $110,000 vehicle. If the market moves just 1% against you, a standard move in a volatile week, that is a loss of $1,100. That is 50% of your margin requirement gone in a blink. If you were trading with an offshore broker offering 500:1 leverage, you might have opened that same $110,000 position with only $220 in your account. A 1% move against you is still a loss of $1,100. But you only had $220. You are mathematically dead the moment the market sneezes. The broker's computer automatically liquidates your position. The millisecond your equity falls below a certain percentage of the required margin. This is the margin call. In Forex, it is often a silent execution. You look at your phone, the trade is gone, and your balance is near zero. Now let us cross the border into the futures market. Here the terminology changes and the mechanics of the loan are more rigid. In futures, we do not typically talk about leverage ratios like 50 to 1. We talk about margin requirements, specifically distinguishing between intraday margin and maintenance margin. Every futures contract has a standardized maintenance margin set by the exchange, like the CME. This is a scientifically calculated number based on the volatility of the asset, often using a system called SPAN, Standard Portfolio Analysis of Risk. For example, to hold one contract of the E-mini S&P 500, ES, overnight, the exchange might require you to have $12,000 in your account. Since the contract's notional value might be around $220,000, this is effectively leverage of about 18:1. It is conservative. It is designed to ensure that if the market gaps while the exchange is closed, you can cover your losses. However, to attract retail traders, futures brokers offer a special discount known as intraday margin or day trading margin. They might say, if you open and close the trade between 9:30 a.m. and 4 p.m., you only need $500 in your account to trade that same S&P 500 contract. This is where the seduction lies. $500 to control $220,000. That is leverage of 440:1. It is massive. It allows you to make incredible returns on a small account, but it introduces a distinct risk that does not exist in Forex: the overnight cliff. Imagine this scenario. You are a futures trader. You buy the E-mini S&P 500 at 3:55 p.m. Eastern Standard Time using your broker's $500 day trading margin. The trade goes slightly against you, but you are convinced it will turn around. You decide to hold. You wait. The clock ticks to 4 p.m. Eastern Standard Time. The market closes for the day session. At that exact second, your broker's discount expires. The requirement to hold that contract instantly jumps from the $500 intraday rate to the $12,000 exchange maintenance rate. If you do not have $12,000 cash in your account, you are in violation of the exchange rules. Your broker's risk algorithm will instantly trigger. They will liquidate your position at whatever price they can get, often a terrible one, and they will likely charge you a hefty liquidation fee, on top of your losses for the privilege of cleaning up your mess. In Forex, you can generally hold a position forever as long as you have the equity. In futures, the clock is a guillotine. You must know exactly when the session ends, or the margin requirements will crush you. Let's look at the concept of notional value more deeply, because this is where the two markets diverge in sizing flexibility. In Forex, you have incredible granularity. If a standard lot, 100,000 units, is too big, you can trade a mini lot, 10,000 units, a micro lot, 1,000 units, or even a nano lot, 100 units. This allows you to fine-tune your leverage and risk down to the penny. You can scale into a position smoothly. In futures, you are dealing with standardized blocks. You cannot trade 1.5 contracts of crude oil. You trade 1 or 2 or 10. If the standard crude oil contract, CL, is too big, representing 1,000 barrels, you have to step down to the micro crude oil contract, MCL, which is 100 barrels. There is no middle ground. If the micro is still too big for your risk management plan, you simply cannot trade that asset class. You are priced out. The futures market is less forgiving of small capitalization. It demands that you have enough money to handle the minimum block size of the global economy. Furthermore, we have to talk about the physical settlement versus cash settlement, which ties into why margin exists. In spot Forex, you are technically trading for physical delivery of currency, but in reality, positions are rolled over indefinitely. You never actually receive a truckload of euros. The margin is just to cover price changes. In futures, many contracts are physically settled. If you hold a live cattle futures contract until expiration, technically, you are obligated to receive a delivery of actual cattle. If you hold a corn contract, you own the corn. Because of this physical reality, as the contract approaches its expiration date, brokers will force you to close your position or roll it to the next month. They will not let you accidentally buy a herd of cows. This adds a layer of logistical management to futures trading that simply does not exist in Forex. In Forex, you just hold. In futures, you have to manage the contract month. You have to know when the volume is shifting from the September contract to the December contract. If you trade the wrong month, you might find yourself in a liquidity desert with massive spreads and erratic moves. This brings us to the harsh reality of gap risk. Because Forex is a 24/5 market, it rarely stops. Price is continuous. If you hold a trade overnight on Tuesday, price flows smoothly into Wednesday. Gaps, where price jumps from one level to another without trading in between, usually only happen over the weekend. Futures markets have daily closes. The S&P 500 futures close for a maintenance period every afternoon. They close for the weekend. When they reopen, price can, and often does, gap significantly. If news breaks while the market is closed, the opening price might be vastly different from the closing price. If you are holding a position with high leverage, a gap can jump right over your stop-loss order. Your stop-loss is not a guarantee, it is a trigger. If the price gaps past your trigger, you get filled at the next available price, which could be massive points away. You could lose more than your entire account balance. You could end up owing the broker money. This is the nightmare scenario of leverage, negative equity. So we have established that Forex offers flexible sizing and continuous pricing, but hides danger in massive leverage and offshore regulatory gaps. We have established that futures offer transparency and centralization, but impose rigid contract sizes and the constant threat of the margin cliff. But let's assume you navigate all of this. You manage your leverage perfectly. You avoid the margin call. You enter the trade and you make a profit. Now the invisible hands come for their share. You might think trading is free because your Forex broker advertises zero commissions. Or you might think the $5 fee on a futures trade is the only cost. You would be wrong. There is a silent killer in trading. It eats away at your edge every single time you click the button. It varies wildly between these two markets, and it transforms depending on the time of day. In one market, it is a transparent fee you can calculate to the cent. In the other, it is a murky widening gap that can turn a winning strategy into a losing one without you ever knowing why. We are talking about the cost of doing business, spreads, commissions, and the mysterious swap fee. In the financial world, whenever you hear the phrase zero commission, you should instinctively grip your wallet tighter. There is no such thing as a free lunch in global economics, and there is certainly no such thing as a free trade. The brokerage industry is not a charity. It is a business designed to extract revenue from flow. The difference between Forex and futures lies in how they extract that revenue. Whether they charge you at the front door with a ticket price, or whether they silently skim off the top of every transaction you make. Let's dismantle the zero commission Forex model first. This is the primary hook used to lure new retail traders. You open an account, and the broker promises that buying the euro to US dollar costs you nothing in fees. This is technically true, but practically false. Instead of a commission, you pay the spread. The spread is the difference between the bid price, what you can sell for, and the ask price, what you can buy for. Imagine you walk into a currency exchange booth at the airport. The screen says they will sell you euros for $1.10, but if you want to sell those euros back to them immediately, they will only give you $1.05. That 5-cent gap is their profit. In the digital Forex market, this gap is much smaller, measured in pips, but the mechanics are identical. You are starting every single trade in the negative. If the spread is 2 pips, the market must move 2 pips in your favor just for you to break even. The danger in Forex is not that the spread exists. It is that the spread is variable or floating. This is a critical concept. In the futures market, the spread is often effectively fixed at the minimum price increment, known as a tick, largely due to the massive liquidity in the central limit order book we discussed earlier. In the E-mini S&P 500, the spread is almost always 0.25 points during active hours. It rarely fluctuates. You can model your costs with precision. In spot Forex, the spread is alive. It breathes, and it tends to expand at the worst possible moments for you. Let's look at a case study. You are scalping the pound sterling to US dollar. It is 4:59 p.m. New York time. The liquidity providers, the big banks, are resetting their servers for the new trading day. Liquidity evaporates. Suddenly, that tight 1.5 pip spread you were trading all day explodes to 20 pips for a few minutes. If you had a stop-loss resting near the price, you are triggered not because the market value changed but because the cost of doing business momentarily spiked. You were stopped out by the spread. This phenomenon is almost non-existent in futures during liquid hours, where the spread is transparent and competed for by thousands of algos. Now look at the futures cost structure. It is brutally honest. You pay a commission. It might be $2 per side, meaning a round turn cost of $4 to open and close a trade. Psychologically, new traders hate this. They see their account balance drop by $4 the second they enter. Feels like a penalty. But do the math. If you are trading one standard lot of euro to US dollar in Forex, worth $10 per pip, and the spread is 1.0 pip, Your cost to open that trade is effectively $10. You just don't see it as a line item deduction, you see it as a worse entry price. So compare them. The futures trader pays a transparent $4 commission. The Forex trader pays an invisible $10 spread. In this scenario, the commission-free Forex trade is actually 150% more expensive than the futures trade. This is why professional scalpers gravitate toward futures. When you are making hundreds of trades, paying $4 is mathematically superior to paying $10, even if the $10 is hidden. But the costs do not end when the trade is executed. If you are a swing trader, someone who holds positions for days or weeks, you face a different beast entirely. In Forex, this beast is called the swap or rollover. Forex trading is always done in pairs. You are borrowing one currency to buy another. Because you are effectively borrowing money, you have to pay interest on it. Conversely, because you are holding a currency, you earn interest on that. The swap fee is the net difference between the interest rates of the two countries. Let's imagine a scenario where the US Federal Reserve has an interest rate of 5% and the Bank of Japan has an interest rate of 0%. If you buy US dollar to Japanese yen, you are holding the high-interest US dollar and borrowing the low-interest yen. Theoretically, the broker should pay you the difference. This is called positive carry. However, retail brokers often add their own markup to these rates. So instead of getting paid, you might receive nothing or pay a small fee. Now reverse it. If you sell US dollar to Japanese yen shorting the dollar, you are borrowing the expensive dollars to hold cheap yen. You owe the interest difference. Every single day at 5 p.m. Eastern Standard Time, your broker debits your account. If you hold a large short position for weeks, these swap fees can bleed your account dry, turning a winning trade on the chart into a losing trade in your balance. And here is the kicker that catches thousands of novices off guard. Triple Swap Wednesday. Because Forex trades take 2 days to settle, if you hold a trade open past 5 p.m. on Wednesday, you are charged for the weekend swap in advance. You get hit with 3 days of interest fees in 1 second. If you are highly leveraged, this single fee can be substantial enough to trigger a margin call if you are running too close to the edge. How does futures handle this? Do they charge you a daily swap fee? Generally, no. Futures contracts do not have a daily interest debit hitting your cash balance. Instead, the cost of carry is baked into the price of the contract itself. This is why the price of the S&P 500 futures contract is not exactly the same as the S&P 500 index. The difference represents the interest needed to finance the position until the contract expires. As a swing trader in futures, you don't see money leaving your account every night at 5 p.m. This simplifies your cash flow management. However, you have a different hurdle. Rollover. Futures contracts expire every few months: March, June, September, December. If you want to hold a long-term position for 6 months, you cannot just sit there. You must physically close the expiring contract and open a new one in the next month. This involves paying the spread and commission again. Let's visualize a battle of the costs between two traders, Alice and Bob, both wanting to short the S&P 500 for 1 month. Alice uses a CFD, contract for difference, or Forex broker to short the index. She pays no commission, but she pays a spread on entry. Then, every single night for 30 nights, she is charged a financing fee, or swap for borrowing the leverage. By the end of the month, even if the market hasn't moved, Alice might be down 2% of her account just from financing fees. Bob uses the E-mini futures. He pays a $4 commission to enter. He holds for 30 days. He pays 0 daily financing fees from his cash balance. The market doesn't move. Bob is down only his $4 commission. The cost of carry was priced in, meaning the contract price slowly converged with the spot price, but his cash balance wasn't rated nightly. For long-term holding strategies, the structural cost of futures is often far superior to the daily bleed of Forex swaps. There is one final, hidden cost that is rarely discussed: data fees. In the Forex world, data is free. Your broker gives you the charts, the quotes, and the news for $0. Why? Because, as we discussed, they are often the counterparty. They want you to trade. They are the casino giving you free drinks. In the futures world, data is a commodity. The CME Group owns the price data. If you want live, tick-by-tick data for the Nasdaq or crude oil, you have to pay a monthly subscription fee to the exchange. It might be $5 a month or $30 a month, depending on the depth of data you need. To a beginner, paying for data feels archaic. Why should I pay for quotes? They ask. The answer is quality. You are paying for the unfiltered, unmanipulated feed directly from the exchange source, not a derivative feed massaged by a broker who is betting against you. You are paying for the truth. So, we have analyzed the plumbing, the leverage, and the costs. You might be thinking, okay, futures seem more transparent, but Forex seems more accessible. But there is another variable that overrides everything we have discussed so far. It is the one thing you cannot control, yet it dictates the success or failure of every strategy. It is the reason why a strategy that prints money at 9 a.m. might bankrupt you at 2 p.m. We need to talk about time. You have been told Forex is a 24-hour market that never sleeps. You have been told you can trade whenever you want. This is technically true, but practically, it is a lie that leads to ruin. The market has a rhythm, a heartbeat, and dead zones where predators wait for the uninformed. In the next part, we are going to overlay the global map on your clock and reveal exactly why trading anytime is the fastest way to lose everything. The promise of the 24-hour market is arguably the most expensive marketing slogan in the history of retail trading. Suggests freedom. It implies that you can finish your day job, put the kids to bed, sit down at your computer at 9 p.m., and trade your way to financial independence. While the market is technically open, meaning the servers are running and prices are ticking, trading during the wrong hours is like trying to surf in a swimming pool. There might be water, but there are no waves. And without waves, you cannot move. You can only drown. To understand the difference between Forex and futures regarding time, you have to understand the source of their liquidity. Liquidity is the oxygen of the market. Without it, price movement becomes erratic, spreads widen, and technical analysis fails because there is no crowd wisdom driving the trend. Let's look at the Forex market first. It is often described as a relay race. It follows the sun around the planet. It begins in New Zealand and Australia, passes the baton to Tokyo and Singapore, the Asian session, then hands it off to London and Frankfurt, the European session, and finally sprints to the finish line in New York, the North American session. Here is the trap. The volume in these sessions is not equal. The Asian session for a pair like the euro to US dollar is often a graveyard. Imagine a trader, let's call him Mike. Mike lives in Chicago. He gets home from work and opens his charts at 7 p.m. Central Standard Time, 8 p.m. Eastern Standard Time. He sees the euro to US dollar moving sideways in a tight 10-pip range. He is desperate for action, so he zooms into the 1-minute chart. The noise looks like a trend. He buys. The price moves up 2 pips, then drops 4 pips. Chops him to pieces. He is losing money not because his strategy is wrong, but because the banks in London and New York, who control the vast majority of euro volume, are closed. He is trading against algos in Tokyo that are simply keeping the lights on. This is known as the Asian range. Now, contrast this with the London breakout at 3 a.m. Eastern Standard Time. When the Frankfurt and London desks come online, massive institutional capital floods the market. The price explodes out of that tight Asian range. If Mike were trading then, he would see clean directional moves. But Mike is asleep. The Forex market structure favors those who can trade during the European and US overlap, 8 a.m. to 12 p.m. Eastern Standard Time. If you cannot trade during these specific windows, the 24-hour advantage of Forex is actually a disadvantage, because it allows you to lose money during times when you shouldn't even be at the desk. Now let's pivot to futures. The structure of time here is more rigid, more binary, and arguably more honest. While electronic futures like the E-mini S&P 500 trade almost 24 hours a day on the Globex system, there is a distinct concept known as RTH, regular trading hours. For the US equity markets, this is 9:30 a.m. Eastern Standard Time to 4 p.m. Eastern Standard Time. This is when the New York Stock Exchange is open. This is when the actual stocks that comprise the index are being bought and sold. In the futures market, the opening bell at 9:30 a.m. is a violent event. It is not a gentle baton pass like in Forex. It is a gunshot. Volume spikes vertically. The difference between trading the E-mini S&P 500 at 8:30 a.m. versus 9:30 a.m. is the difference between a skirmish and a war. This creates a distinct advantage for the futures trader. Predictable volatility. You know exactly when the bus is leaving the station. You can plan your entire day around the 9:30 a.m. to 11 a.m. window. You do not need to watch the charts all day. You show up for the open, you trade the volume, and you leave. However, futures have a time risk that Forex generally does not: the settlement gap. We touched on this briefly, but let's go deeper. Most futures markets close for a maintenance period, usually between 5 p.m. Eastern Standard Time and 6 p.m. Eastern Standard Time. Times vary by asset. During this hour, you effectively cannot trade. The market is halted. If news breaks during this hour, say a war starts or a major political scandal erupts, you are trapped. You cannot exit. When the market reopens at 6 p.m., the price will not move there. It will teleport there. It will open limit down or limit up. In Forex, because the market is decentralized, there is almost always a bank somewhere willing to quote a price, even if the spread is terrible. You can usually get out. In futures, when the exchange is closed, the door is locked. Let's explore the overnight inventory phenomenon in futures. This is a concept that professional futures traders obsess over. If the market trends up all night during the Asian and European session, on the futures Globex overnight session, we enter the US morning session with long inventory. The market is effectively tired or overbought before the day even begins. Professionals look at this and ask, will the US traders validate this overnight move, or will they undo it? Often you see a counter-rotation at 9:30 a.m. The US traders reject the prices established by the overnight speculation. This creates a specific, repeatable trade setup that only exists because of the hard distinction between overnight and R2 sessions. Forex does not have this hard line. The flow is continuous, blurring the lines of inventory. Consider the psychological impact of these time constraints. In Forex, the market is an endless river. This encourages overtrading. There is always a candle forming. There is always a potential setup. It breeds addiction. The fear of missing out, FOMO, is perpetual because the market never stops. In futures, the close is a hard stop. At 4:15 p.m. Eastern Standard Time for many indices, the game ends. The scoreboard is finalized for the day. This provides a psychological closure that is healthy for longevity. You can walk away. You are forced to flat your positions, if you are a day trader, or settle your margin. The market tells you, go home. For a trader struggling with discipline, the rigid schedule of the futures market is a guardrail. The endless nature of Forex is an enabler. Let's look at a specific case study of news events in time. The non-farm payrolls (NFP) report is released at 8:30 a.m. Eastern Standard Time on the first Friday of the month. In the futures market, this is 1 hour before the stock market opens. The futures are trading electronically. The liquidity is thinner than during the day session. When the number hits, the moves are violent and often fake. A futures trader knows that the real move might not happen until 9:30 a.m. when the cash market opens and the big asset managers rebalance their portfolios based on the data. In the Forex market, 8:30 a.m. Eastern Standard Time is the absolute peak of the London/New York overlap. It is prime time. The liquidity is at its maximum. The move you see in euro to US dollar at 8:30 a.m. is often the real move. There is no second opening waiting to happen an hour later. The structural reaction to time and news differs, and treating them the same is a fatal error. Furthermore, we must address the weekend gap. Forex markets close Friday afternoon and open Sunday afternoon, US time. Weekend gaps in Forex can be substantial, but they are usually dictated by geopolitical shifts over the weekend. Futures also have weekend gaps, but because futures are often proxies for physical goods, like oil or corn, or specific indices, the gaps can be driven by weather reports released on Saturday or specific supply chain news. The source of the time gap risk varies. So we have defined the battlefield. We know that Forex is a continuous, fluid environment where you must hunt for liquidity during specific global overlaps. We know that futures is a structured, session-based environment with hard opens and closes that dictate strategy. But knowing when to fight and where to fight is useless if you are bringing a knife to a gunfight. This brings us to the technological divide. The software you use to access these markets is not just a window, it is a weapon. In the retail Forex world, you are likely using a platform that was designed in 2005, built for simplicity, and effectively hides the data you need to win. In the futures world, the standard platforms are like the cockpit of a fighter jet, complex, intimidating, but giving you X-ray vision into the market's intent. Most retail traders are losing because they are making decisions based on lines on a chart, while the professionals are making decisions based on the order flow inside the candle. In the next part, we are going to rip apart the software industry. We are going to compare MetaTrader against platforms like Sierra Chart and NinjaTrader, and I will show you why the free platform your broker gave you is designed to keep you blind. If you are trying to win a Formula One race, you do not show up in a Toyota Camry. It does not matter how good a driver you are. If your vehicle cannot handle the G-force, the speed, and the precision required for the track, you will lose. In the world of trading, your platform is your vehicle. And the uncomfortable truth is that the vast majority of retail Forex traders are driving a sedan while trying to race against institutional Ferraris. Let's look at the industry standard for retail Forex, MetaTrader 4 or MT4. If you have ever opened a Forex account, you know this software. It looks like it was designed in Windows 95. It is clunky, the charts are basic, and the interface is rigid. Yet, it remains the most popular trading platform on Earth. Why? Is it because it offers the best analytics? No. Is it because it gives traders an edge? Absolutely not. It is popular because it is free for you, and it is incredibly easy for brokers to manage. It was built for the broker, not for the trader. Its primary function is to execute orders and display historical price. Tells you where the price has been. Now contrast this with the platforms used by professional futures traders. Software like Sierra Chart, NinjaTrader, Jigsaw Day Trader, or TT Trading Technologies. These platforms are not usually free. They require monthly subscriptions or lifetime licenses. They require data feeds that cost money. But they provide something that MetaTrader simply cannot: X-ray vision. They tell you where the price is likely to go based on the intent of other participants. To understand this difference, we have to talk about the DOM, the depth of market. In a professional futures platform, the DOM is the centerpiece of the screen. It is a vertical ladder showing the current price in the middle. Above the price, you see a list of numbers. These are the limit sell orders waiting to be filled. Below the price, you see the limit buy orders. You can see in real time that there are 500 contracts waiting to be sold at 4,505.00, and only 50 contracts waiting to be bought at 4,504.00. This is not just data. It is a tactical map. If you are a futures trader and you want to go long, but you look at the DOM and see a massive wall of 2,000 sell orders sitting 2 ticks above you, you know that for the price to move up, buyers have to chew through all 2,000 of those contracts. That is a heavy lift. You might decide to wait. You have information that stopped you from taking a low probability trade. Now, imagine the Forex trader on MetaTrader taking the exact same setup. They do not have a DOM. They cannot see the limit orders because, as we established in Part 2, there is no central exchange to aggregate that data. The Forex trader sees a bullish engulfing candle on the chart. They see their RSI indicator crossing below 30. They think, this is a buy. They click the button. The price moves up 2 pips, hits that invisible wall of sell orders they couldn't see, and immediately reverses, stopping them out. The Forex trader is left scratching their head, blaming market manipulation, while the futures trader is simply watching the order flow do exactly what the data said it would do. This brings us to the concept of order flow and footprint charts. This is the technological divide that separates the amateurs from the pros. A footprint chart, which is standard in high-end futures software, takes a normal candlestick and splits it open. Inside the candle, it shows you exactly how many contracts were bought at the ask and how many were sold at the bid at every single price level. Imagine a scenario where the market is falling fast. It hits a support level. A normal candlestick chart shows a red candle. It looks bearish. The Forex trader sees momentum and sells, thinking the breakdown is imminent. But the futures trader looks at the footprint chart inside that red candle. They see something fascinating. At the bottom of the candle, they see thousands of sell orders hitting the bid, but the price is not moving down. The numbers are racking up: 100, 200, 500 sold, but price is stuck. This is called absorption. It means a passive buyer is sitting there with a giant basket, catching every single sell order. The aggressive sellers are exhausting themselves. The futures trader sees this absorption and thinks, the sellers are trapped. They are using up all their ammo and can't push price down. When they realize this, they will panic and buy back to cover. The futures trader buys the support. The Forex trader, looking at the same red candle without the internal data, sells the breakdown. The market rips upward. The futures trader profits. The Forex trader loses. The difference wasn't skill. It was visibility. One had a map of the minefield. The other was walking blindfolded. Let's discuss the add-on ecosystem. In MetaTrader, you have expert advisors, EAs, and indicators written in MQL. The marketplace is flooded with thousands of holy grail indicators. Arrows that point up or down, clouds that change color. These are almost exclusively based on lagging mathematical formulas derived from past price. They are derivatives of derivatives. In the future software ecosystem, the tools are designed to visualize raw data, not to interpret it for you. You don't get a buy arrow. You get a cumulative delta wave. Delta is the difference between aggressive buyers and aggressive sellers. If price is making a new high but cumulative delta is making a lower high, it tells you that despite the price going up, the actual aggression is drying up. It is a divergence based on volume, not just price speed. This is a leading indicator. It warns you of a reversal before the price actually turns. Retail Forex platforms generally cannot calculate accurate delta because they lack the centralized volume data to feed the algorithm. There is also the issue of tick data versus level 2 data. In Forex, when you backtest a strategy on MetaTrader, you are often using tick data. A tick is just a price update. It doesn't tell you if one lot was traded or 10 million lots were traded. It just means the price moved. Testing a strategy on this is flimsy. In futures, you have level 2 data. You know the size. You can filter your charts to only show trades larger than 50 contracts. This allows you to ignore the noise of the retail crowd and only watch the whales. You can set up your software to trigger an alarm sound only when a block trade of over 100 contracts hits the tape. This alerts you that a big player has entered the room. You cannot filter for smart money in spot Forex because the volume of the smart money is hidden in the dark pools of the interbank network. We must also address the cost mentality. Many new traders refuse to pay for software. They see a $50 monthly fee for a platform or a $1,000 lifetime license as an obstacle. They think, I want to keep my overhead low. This is poverty thinking. If a $50 platform saves you from taking one bad $100 loss per month, it has paid for itself twice over. If a superior platform helps you spot one extra winning trade, it is an asset, not a liability. In futures, paying for your tools is the entry fee for doing business professionally. It filters out the hobbyists. In Forex, the free tools create a culture of gambling, where the barrier to entry is zero, and the cost of failure is total. However, moving to a professional futures platform requires a learning curve. These are not plug-and-play apps. You have to configure the servers. You have to map the data feeds. You have to customize your ladders and your shortcuts. It takes weeks to master the interface of Sierra Chart or NinjaTrader. But that friction is good. It forces you to treat trading like a profession. You have to learn your instrument. You wouldn't expect to fly a Boeing 747 just by hopping in the cockpit and pressing go. You need to understand the dials. So let's assume you have made the switch. You are trading futures. You are respecting the session times. You are using a professional platform with level 2 data. You are seeing the absorption, tracking the delta, and managing your leverage. You are finally becoming profitable. You are making real money. Now a new adversary appears. This one doesn't care about your charts. It doesn't care about your stop loss. It doesn't care if you traded the euro or the S&P 500. It only cares about the bottom line on your ledger at the end of the year. And depending on which instrument you chose, Forex or futures, this adversary is going to take a vastly different chunk of your profits. Most traders never think about taxes until April, and by then it is too late. The United States tax code discriminates heavily between these two markets. One is treated as a generic investment, subject to the highest possible tax rates. The other is given a golden ticket status with a blended rate that can save you thousands, or even tens of thousands of dollars, simply because of the asset class you clicked buy on. In the next part, we are going to open the tax code and reveal the massive 60-40 advantage that futures traders enjoy, and the Section 988 trap that awaits the Forex trader. I am not a CPA, a tax attorney, or a financial advisor. The following information regarding U.S. tax law is for educational purposes only, and is based on the Internal Revenue Code as of the current tax year. Tax laws are subject to change and vary depending on your individual jurisdiction and financial situation. You must consult with a qualified tax professional to file your taxes correctly. Now let's open the books. Most traders are obsessed with alpha, the edge that helps them beat the market. They spend years refining their entry criteria, optimizing their risk-to-reward ratios, and backtesting their algorithms. But there is a form of alpha that requires no chart analysis, no indicator, and no predictive ability. It is called tax alpha. It is the money you keep simply because you understood the rules of the game before you started playing. And in the United States, the tax code is not neutral. It explicitly favors one of these markets over the other. If you trade spot Forex as a U.S. resident, you fall under a specific section of the tax code, known as Internal Revenue Code, IRC, Section 988. By default, spot Forex transactions are treated as ordinary income. This is a crucial classification. It means that in the eyes of the IRS, your trading profits are taxed exactly the same way as wages from a job, interest from a bank account, or non-qualified dividends. Let's run a scenario to see the impact of this. Imagine you are a successful Forex trader named David. You have had a banner year. After thousands of trades, stressful nights, and rigorous discipline, you have netted a profit of $100,000. David is a high earner. Perhaps he has a day job or other income that pushes him into the top federal tax bracket of 37%. Because Section 988 treats his Forex wins as ordinary income, that $100,000 is taxed at his marginal rate of 37%. He writes a check to the U.S. Treasury for $37,000. We are not even including state taxes yet, which could add another 5% to 13% depending on where he lives. David keeps $63,000 of his hard-earned money. Now let's look at the futures market. Futures contracts, including the E-mini S&P 500, gold, crude oil, and even currency futures like the 6E Euro futures, are regulated under IRC Section 1256. This is the golden ticket I mentioned. Section 1256 contracts benefit from a unique 60/40 tax treatment. Here is how the math works. No matter how long you hold the trade, whether it was for 5 seconds or 5 months, 60% of your gains are taxed at the favorable long-term capital gains rate. The remaining 40% are taxed at the short-term capital gains rate, which is effectively your ordinary income rate. Let's look at our second trader, Lisa. She traded futures. She traded the exact same price moves as David, but she used the 6E Euro futures contract instead of spot euro to US dollar. She also made exactly $100,000 in profit. She is in the same 37% tax bracket as David. Here is Lisa's tax bill. Of her $100,000 profit, $60,000, 60%, is treated as long-term capital gains. The maximum tax rate for this is currently 20% for high earners. So, on this portion she pays $12,000. The remaining $40,000, 40%, is treated as short-term capital gains. This is taxed at her ordinary rate of 37%. On this portion she pays $14,800. Total tax bill: $12,000 plus $14,800 equals $26,800. Compare the two checks. David, the Forex trader, paid $37,000. Lisa, the futures trader, paid $26,800. Lisa saved $10,200 simply because she chose a different instrument. That is a 10.2% pure profit boost that required zero extra risk, zero extra leverage, and zero extra market insight. Over a 10-year career, compounding that tax savings, the difference could buy a house. This is the structural edge of Section 1256. But the rabbit hole goes deeper. We have to talk about loss treatment. Trading is difficult, and losses are inevitable. How the IRS allows you to handle those losses can determine if you survive to trade another year. In Section 988, Spot Forex, losses are treated as ordinary losses. This actually has one benefit. There is no limit to the amount of ordinary losses you can deduct against your ordinary income. If you lose $50,000 in Forex, you can potentially deduct that full $50,000 against your W-2 job income, lowering your overall tax bill significantly. This is the one area where Forex can be more flexible than stocks, where capital losses are capped at $3,000 per year against ordinary income. However, futures, Section 1256, have a superpower called the loss carryback. If Lisa has a terrible year and loses $100,000 in futures, she can carry that loss back to the 3 previous tax years. If she paid taxes on futures gains in those years, she can apply the current loss to those past gains and receive a refund check from the IRS for taxes she already paid. It is a form of retroactive insurance. Section 988 Forex traders generally cannot carry back losses. They can only move forward. This carryback provision is a massive safety net for professional volatility traders who might have one bad year after 3 good ones. Then there is the administrative nightmare known as the wash sale rule. If you trade stocks, you know this rule. It states that if you sell a security at a loss and buy a substantially identical security within 30 days before or after the sale, you cannot claim the loss on your taxes. It is designed to prevent people from manufacturing tax deductions. For active day traders, the wash sale rule is a headache. You are constantly buying and selling the same ticker. Calculating which losses are disallowed requires complex accounting software. Here is the beauty of futures. Section 1256 contracts are exempt from the wash sale rule. Completely exempt. Why? Because of a mechanism called mark-to-market accounting. At the end of the tax year on December 31st, the IRS treats every single open futures position in your account as if you had closed it at the market price that day. You calculate your total profit or loss for the year based on this theoretical closing. Because you are marked to market and taxed on the net value of your account annually, the IRS does not care if you rebut the same contract 5 minutes later. This simplifies your reporting drastically. You generally receive a single one-page form from your broker, the 1099-B, with one aggregate number for aggregate profit or loss on contracts. You plug that one number into Form 6781, and you are done. Now, compare this to the spot Forex trader. Many Forex brokers, especially those offshore, do not issue a standardized 1099-B. They give you a raw CSV file of your 5,000 trades. You or your accountant have to crunch the exchange rates for every single trade. And while spot Forex is technically Section 988, which avoids wash sales because it's not a capital asset, if a Forex trader tries to opt out of Section 988 to get capital gains treatment, which is a legal maneuver some try, they suddenly walk right into the wash sale trap and complex record-keeping requirements without necessarily getting the 60/40 split benefit. It is a minefield of complexity. There is a caveat here that I must stress. The 60/40 rule applies to regulated futures contracts traded on U.S. exchanges, like the CME, CBOT, NYMEX. It does not automatically apply to CFDs, contracts for difference, traded by Europeans or offshore accounts. If you are a U.S. citizen trading CFDs offshore, which is already a regulatory gray area, you are likely stuck with ordinary income treatment or worse, passive foreign investment company, PFIC, rules which are draconian. The tax advantage is a reward for playing within the regulated U.S. futures ecosystem. So let's summarize the scoreboard. Futures, 60/40 preferential tax rates, simple one-page reporting, exemption from wash sales, and loss carryback provisions. Forex, high ordinary income tax rates, complex reporting, and no loss carryback. Seems like an open and shut case. Why would anyone choose Forex? Well, there is a dark side to the futures world that we haven't touched yet. A risk that has nothing to do with price, nothing to do with taxes, and nothing to do with your skill. It is a risk inherent to the structure of the broker itself. In the Forex world, you have likely heard horror stories of brokers simply disappearing. The bucket shops. The scams. But you assume that in the heavily regulated U.S. futures market, your money is safe, right? You assume that because the CME is a fortress, your broker is also a fortress. History tells a different story. History tells us about a man named John Corzine. It tells us about a firm called MF Global. It tells us about PFG Best and a CEO who tried to commit suicide while hiding a 20-year fraud. In the next part, we are going to explore segregated funds versus sweep accounts. We are going to look at what actually happens to your money when you deposit it with a futures broker, and the one terrifying scenario where even the regulated U.S. traders lost everything. We assume that when we deposit money into a brokerage account, it sits in a vault with our name on it. We assume that if the broker goes bankrupt, our money is untouchable because it belongs to us, not them. In the banking world, this is largely true due to FDIC insurance. In the stock market, you have SIPC insurance protecting you up to $500,000 if your broker collapses. But in the futures and Forex markets, the safety net is constructed differently, and history has shown that it has holes large enough for billions of dollars to fall through. To understand the risk, we have to revisit October 2011. MF Global was not a shady offshore bucket shop. It was a primary dealer for the U.S. Federal Reserve. It was a massive, publicly traded financial institution led by John Corzine, a former governor of New Jersey and former CEO of Goldman Sachs. It was the definition of too big to fail in the derivatives world. Retail traders, hedge funds, and farmers held accounts there, believing their funds were sacrosanct. The rule in futures is segregation. The Commodity Futures Trading Commission, CFTC, mandates that customer funds must be kept separate from the firm's own operating capital. The firm cannot use your money to pay its rent, its electric bill, or crucially, to fund its own proprietary trading bets. It is a firewall. But in 2011, MF Global made a massive leveraged bet on European sovereign debt. They bet that countries like Italy and Spain would not default. As the Eurozone crisis worsened, those bonds plummeted in value. MF Global faced massive margin calls from its own clearinghouses. Desperate to stay afloat and buy time, the firm broke the cardinal rule. In the chaotic final days, executives authorized the transfer of money from the segregated customer accounts into the house accounts to plug the hole. When the dust settled and the firm filed for bankruptcy, $1.6 billion of customer money was missing. Imagine being a trader on that day. You wake up, check your platform, and you are locked out. You call your broker and no one answers. You watch the news and hear that your money, your trading capital, your livelihood, has effectively vanished into the balance sheet of a bankrupt giant. It took years of litigation for customers to get their money back, and for a long time, many feared they would get pennies on the dollar. This shattered the illusion of absolute safety in the U.S. regulated futures market. Less than a year later, in July 2012, it happened again. Peregrine Financial Group, known as PFG Best, collapsed. This story was even more disturbing because it wasn't a complex trading error. It was a 20-year fraud. The CEO, Russell Weisendorf, had been intercepting bank statements, physically cutting out the numbers, pasting in fake balances, and photocopying them to send to the regulators. He was running a massive Ponzi scheme right under the nose of the NFA. When the regulators finally switched to electronic verification, Weisendorf attempted suicide and left a note confessing that over $200 million of customer money was gone. These are not ancient history. These are modern warning shots. They highlight a critical distinction regarding insurance. If you open a stock trading account with a firm like TD Ameritrade or E-Trade, you are covered by the Securities Investor Protection Corporation, SIPC. If the broker steals your money or goes bust, SIPC steps in. Futures accounts do not have SIPC coverage. There is no government-backed insurance policy for your futures trading account. If your futures commission merchant, FCM, goes insolvent and the segregated funds are missing, you become a creditor in a bankruptcy proceeding. You stand in line with the landlords and the utility companies, hoping there are assets left to liquidate. This is a risk that almost no YouTube guru talks about. You are taking on the credit risk of the firm you hold your money with. So, how does this compare to Forex? In the U.S. regulated Forex environment, the situation is similar regarding insurance. There is no SIPC. However, the regulatory capital requirements for U.S. Forex dealers are incredibly high, $20 million minimum, which keeps the small, risky players out. The real danger zone is the offshore Forex world. If you are a U.S. resident trading with an unregulated broker in an island nation to get 500:1 leverage, you have zero protection. If that broker disappears, you have no recourse. You cannot call the police. You cannot sue them in a U.S. court. Your money is a donation. We have seen countless offshore brokers freeze withdrawals, claim technical issues, and then vanish when their Ponzi scheme math stops working. In the MF Global case, there was at least a U.S. court system and a trustee appointed to recover funds. In the offshore Forex world, the server just goes offline. This brings us to the concept of sweep accounts and excess segregation. When you deposit money with a futures broker, they often put it into conservative investments like U.S. Treasury bills to earn interest. However, some brokers use sweep programs to move uninvested cash into money market funds or other vehicles to squeeze out extra yield. You need to read the fine print of your customer agreement. Are you allowing them to sweep your funds? Where are they putting it? Furthermore, you need to understand the difference between an FCM, futures commission merchant, and an IB, introducing broker. An FCM is the powerhouse. They connect directly to the exchange. They hold the money. Examples include massive firms like Goldman Sachs, but also retail-focused ones like RJ O'Brien or AMP Global. An IB is essentially a sales office. They provide the customer service and the platform support, but they do not hold your money. They introduce you to an FCM. When you write a check, you write it to the FCM, not the IB. This is a safety layer. If your local introducing broker goes bust because they didn't pay their phone bill, your money should be safe because it is actually sitting with the FCM. However, you must verify who the FCM is. Always know whose vault your cash is actually in. So, how do you perform due diligence? You do not trust, you verify. For futures and US Forex, you use the NFA's basic database, Background Affiliation Status Information Center. You can type in the name of your broker or their NFA ID. You can see their regulatory history. Have they been fined? Have they been disciplined for failure to supervise? If you see a long list of regulatory actions, run. Additionally, the CFTC publishes a monthly report called Financial Data for FCMs. You can download a spreadsheet that shows exactly how much adjusted net capital each firm has and how much customer segregated funds they hold. You can see if a firm is barely meeting the minimum capital requirements or if they are flush with cash. You want to trade with a firm that is overcapitalized, not one that is living paycheck to paycheck. In the Forex world, you need to check if the broker acts as an A-book or B-book broker, though this information is rarely public. An A-book broker passes your trade to the liquidity provider. They make money on commission. A B-book broker takes the other side of your trade. If you win, they lose. This creates the conflict of interest we discussed in Part 2. While B-book is legal and common, it introduces a moral hazard. If a B-book broker becomes insolvent because too many traders won too much money, they might refuse withdrawals. This happened during the Swiss franc black swan in 2015. When the Swiss National Bank unpegged the franc, the market moved thousands of pips in seconds. Many brokers, both Forex and futures, went into negative equity instantly because their clients couldn't cover losses. The survival of the broker depended on their risk management and the depth of their pockets. The lesson here is diversification. Just as you diversify your trades, you should diversify your counterparty risk. If you have a substantial trading capital, do not keep it all with one broker. Split it. It is an insurance policy you write for yourself. We have now covered the external landscape. We have analyzed the market structure, the leverage, the costs, the software, the taxes, and the safety of your funds. You are now equipped with the technical knowledge that puts you in the top 1% of informed retail traders. But all of this information is useless if the operator of the machine, you, is defective. The final frontier of this comparison isn't about the market, it's about the mind. The psychological profile required to succeed in the high-speed, centralized futures market is radically different from the mindset needed to navigate the decentralized, fluid Forex market. There is a reason why poker players often gravitate to one and chess players to the other. In the next part, we are going to diagnose your psychological type. I am going to ask you 3 uncomfortable questions that will reveal which market you are actually built for, and why trying to force yourself into the wrong one is the reason you are still struggling with discipline. We are moving from the charts to the brain. To solve the puzzle of why you are losing, you have to stop looking at the screen and start looking in the mirror. We spend thousands of dollars on courses, indicators, and mentorships, assuming that the edge is something we can buy. But after coaching thousands of traders, a pattern emerges that is as reliable as gravity. The majority of failures do not occur because the trader lacked knowledge of support and resistance. They occur because there was a fundamental mismatch between the trader's neurological wiring and the market structure they chose to engage with. You are trying to play jazz in a marching band, or you are trying to march in a jazz club. Both lead to dissonance. Both lead to failure. Let's answer the 3 uncomfortable questions I promised you. They are designed to diagnose your trading personality type. Be honest with yourself because the market will punish a lie. Question 1. Do you crave absolute truth? Or are you comfortable with relative truth? This is the divide between the engineer and the artist. If you are the type of person who needs to know exactly how things work, who takes apart the toaster to see the heating element, who demands hard data before making a decision, you are likely wired for the futures market. In futures, as we discussed, the volume is absolute. The depth of market, DOM, is absolute. When you see 500 contracts trade at the bid, that is a hard fact. It is a binary reality. You can build a strategy based on cause and effect. Seller A hit the bid. Price B did not move, therefore absorption occurred. This logic appeals to the analytical mind. It is chess. All the pieces are on the board. If you take that same analytical mind into the spot Forex market, you will go insane. You will look for volume data that isn't there. You will see a price move and ask why. And the answer will be a foggy haze of interbank liquidity shifts. There is no hard volume number to comfort you. However, if you are a person who understands nuance, who is comfortable with ambiguity, and who looks at the big picture rather than the microscopic details, you are wired for Forex. Forex is about relative value. Is the US economy stronger than the Japanese economy? Is the central bank hawkish or dovish? This is a game of probability and intuition derived from macroeconomic currents. It is poker. You have to play the player, not just the cards, and you have to accept that you will never see the whole deck. Question 2. Do you need external discipline, or do you possess internal discipline? This is the most critical question for an addict or someone with impulse control issues. The Forex market is an enabler. It is the bar that never closes. It is the casino that is open on Christmas morning. Because it is a 24/5 continuous flow, there is no external signal to tell you to stop. If you lose $500 at 10 a.m., you can try to win it back at 12 p.m., and again at 3 a.m. This continuity breeds revenge trading. It allows you to dig a hole so deep that you cannot climb out. If you struggle with knowing when to walk away, the Forex market will exploit that weakness until you are bankrupt. It requires massive internal discipline to say, "I am done," when the market is still moving. The futures market acts as a strict parent. The regular trading hours (RTH) concept provides a hard boundary. For the E-mini S&P 500, the prime volume is from 9:30 a.m. to 4 p.m. Eastern Standard Time. Outside of that, the market is often dead. And crucially, the market physically closes for maintenance. Brokers raise margin requirements overnight. These are external friction points. They force you to flatten your book. For a trader with low impulse control, these barriers are lifesavers. They break the trance. If you are the type of person who needs a boss to tell you when the workday is over, the structure of futures is your safety net. Shutterstock. Question 3. What is your relationship with noise? Imagine you are sitting in a room. Do you prefer silence where you can think deeply about one big decision? Or do you prefer a high-energy environment with constant stimulation and rapid-fire decisions? The futures market, specifically the indices like NASDAQ, NQ, or S&P 500 ES, is a high-velocity noise machine during the US session. It is violent. It requires split-second reactions. If you freeze under pressure, or if you get analysis paralysis when data comes at you too fast, the futures DOM will chew you up. It is a video game played at maximum difficulty. Forex, by contrast, can be slower, especially on the higher timeframes where it is most effectively traded. Because the transaction costs, spreads, in Forex are relatively higher compared to the tick movement, it discourages hyperscalping for the average retail trader. It encourages swing trading. It encourages looking at the 4-hour chart or the daily chart. If you are a contemplative thinker, someone who likes to plan a trade on Sunday night and let it play out over 3 days, the Forex market's flow supports that. Trying to scalp the 1-minute chart on Euro to US dollar is often a losing battle against the spread, but catching a 300-pip trend on pound sterling to Japanese yen is where the artist thrives. Let's look at a case study of a trader named Marcus. Marcus is a software developer. He is logical, precise, and obsessed with optimization. He started trading Forex because he heard it was easy to automate. He spent 3 years building expert advisors, trading bots, for MetaTrader. He failed miserably. Why? Because he was trying to apply rigid logic to a decentralized, murky dataset. He was trying to code a path through a swamp. Then Marcus switched to futures. He discovered the DOM. He discovered level 2 data. Suddenly, his coding skills mattered. He could program algorithms based on exact order flow events. He could see the iceberg orders. The structure of the market matched the structure of his brain. Marcus didn't become a better trader overnight. He just moved to a playing field where his specific attributes were assets rather than liabilities. Conversely, consider Sarah. Sarah has a background in geopolitical history and economics. She understands how interest rates affect currency flows. She tried trading futures, specifically the E-mini S&P 500. She hated it. The tick-by-tick noise felt meaningless to her. She didn't care about the 500-lot buyer at 4,505. She cared about the Federal Reserve's meeting next week. She felt rushed and anxious trying to day trade. When she switched to Forex, she stopped looking at the 5-minute chart. She started trading the carry trade. She looked at the Australian dollar to Japanese yen pair. She analyzed the commodity prices supporting the Australian dollar versus the monetary policy of Japan. She placed trades that lasted weeks. She flourished. She wasn't a scalper. She was a macro investor. Futures forced her to be small. Forex allowed her to be big. This leads us to the concept of lifestyle design. We often trade to escape the 9-to-5, but we end up creating a 24-hour prison. If you choose futures, you are effectively signing up for a job with specific hours. You are a day trader in the literal sense. You work the US Open. You are done by lunch. You have the afternoon off. Your work-life balance is compartmentalized. If you choose Forex, you are signing up for a lifestyle of constant monitoring. Because the market moves while you sleep, you are never truly off. You are checking your phone at dinner. You are waking up at 2 a.m. to check the London Open. It bleeds into your life. However, it offers the freedom to trade whenever you have time, rather than only when the NYSE is open. If you live in Australia or Asia, the US futures hours might be in the middle of the night for you, making Forex a more biologically sustainable choice. So look at your life. Look at your time zone. Look at your stress tolerance. If you have a small account, $500 to $1,000, and you want to learn market mechanics with low risk, the microsizing of Forex is a valid sandbox, provided you use a regulated broker. If you have a capitalized account, $5,000 to $25,000, and you want to treat this as a professional business with tax advantages and data transparency, futures is the superior professional product. But there is one final piece of this puzzle. One final hurdle that stops both the Forex trader and the futures trader dead in their tracks. We have covered the legal, the structural, the technical, the financial, and the psychological. You have the map. You have the vehicle. You know the rules of the road. But you still don't have a destination. You don't have a trading plan. Most people watching this video right now have a vague idea that they want to make money. That is not a plan, that is a wish. A plan is a document. A plan is a set of rigid protocols that dictates exactly what you do when the setup appears, and more importantly, what you do when it fails. In the final part of this masterclass, I am going to give you the blueprint. I am going to walk you through the specific steps to launch your career in either of these markets. We are going to build your daily routine, your risk management protocol, and your growth strategy from day 1 to day 90. This is where the theory ends and the execution begins. This is where the theory ends and the execution begins. You have spent the last 9 parts of this series deconstructing the engine of the financial markets. You now know how the gears turn, where the oil leaks are, and which vehicle is safer to drive. But knowledge alone is not power. It is only potential. Power is the ability to take action. If you turn off this video and do not change a single behavior, you have wasted your time. We are going to construct a professional operating procedure. This is not a suggestion. It is a mandate for anyone serious about survival. Your journey starts with the setup phase, which covers days 1 through 7. This is your infrastructure week. If you have chosen the futures route, your first task is to select a futures commission merchant, FCM. Do not just pick the one with the coolest logo. Go to the CFTC website. Download the financial data reports. Find a firm that has excess segregated funds. You are looking for a fortress, not a startup. Once the account is open, you must subscribe to the data feeds. Do not be cheap here. You need level 2 or market depth for the CME group bundles. You need to see the order book. Next, you will install a platform like Sierra Chart, NinjaTrader, or Jigsaw. Spend the entire first week just configuring your workspace. Set up your DOM. Set up your footprint charts. Remove the clutter. You are building a cockpit. If a pilot does not know where the altimeter is, they crash. You must know where your flatten all button is by muscle memory. If you have chosen the Forex route, your infrastructure build is different but equally critical. You must verify your broker's regulatory status. If you are in the US, ensure they are registered with the NFA. If you are outside the US, look for the FCA in the UK or ASIC in Australia. Avoid the unregulated islands. Next, you need to solve the data blindness problem we discussed. Since you cannot get centralized volume, you must subscribe to a professional news squawk service. You need a voice in your ear telling you when central bankers are speaking, or when geopolitical news breaks. You cannot rely on a free economic calendar that updates 5 minutes late. You are trading information, you need to be at the source. Once your infrastructure is built, you enter the simulation phase, covering days 8 through 30. But this is not playing a video game. This is strict rehearsal. You are not allowed to trade randomly. You must define your playbook. You need one setup. Just one. Is it a pullback to VWAP? Is it a break and retest of a key level? Define the entry trigger. Define the stop loss placement. Define the take profit. Write it down on a physical piece of paper and tape it to your monitor. During these 3 weeks, you execute this one setup in a simulator. You are not trying to make $1 million of fake money. You are trying to execute the process without error. If you deviate from the plan, if you move a stop loss, if you chase a trade, you fail the day. You punish yourself by resetting your simulated account balance. You must build the neural pathways of discipline before you introduce the drug of real money. On day 31, if and only if you have executed your plan with 90% discipline in the sim, you enter the live fire phase. But you enter with micro-sizing. In futures, you trade the micro E-mini MES, not the full E-mini ES. The point value is $5 per point, not $50. In Forex, you trade microlots, 0.01, earning or losing cents per pip. The goal here is not income. The goal is to desensitize your amygdala, the fear center of your brain, to the sensation of losing real capital. You will feel your heart rate spike the first time you are in the red. That is normal. Your job is to regulate that emotion. You are training your nervous system to remain cold under pressure. This brings us to the most important document you will ever create: the Risk Management Protocol. This is your survival constitution. It has 3 non-negotiable clauses. Clause 1, the hard stop. You must set a daily loss limit that is hard-coded into your software. If you lose $100 or whatever your risk tolerance is, in a single day the software locks you out. You cannot override it. You cannot revenge trade. You are done. You live to fight another day. Most catastrophic blowups happen because a trader refused to accept a small loss and turned it into a career-ending disaster. Clause 2, the 3-strike rule. If you take 3 consecutive losing trades in a row, you walk away from the desk for at least 1 hour. No exceptions. 3 losses in a row indicate that you are out of sync with the market, or the market conditions have changed and your strategy is no longer working. Continuing to hammer the buy button is not persistence. It is insanity. Clause 3, the metric of truth. You must track 2 specific data points in your journal: MAE, maximum adverse excursion, and MFE, maximum favorable excursion. MAE tells you how much the price went against you before it went in your favor. If your average MAE is 5 ticks but your stop loss is 20 ticks, you are risking too much. You can tighten your stop and increase your position size. MFE tells you how far the price went in your favor before turning back. If your target is 20 ticks but your average MFE is only 12 ticks, you are being too greedy. You need to take profits sooner. These numbers strip away your ego and show you the mathematical reality of your performance. As you progress from day 60 to day 90, you enter the scaling phase. This is where amateurs get slaughtered, but professionals get rich. You do not scale up because you feel good. You scale up because you have earned the right. You create a rule. I must be profitable for 2 consecutive weeks with a maximum drawdown of less than 5% before I can increase my position size by 1 contract. This is a meritocracy. If you lose money, you size down. If you make money consistently, you size up. This natural regulator keeps you safe during bad streaks and maximizes your aggression during winning streaks. Now look at the path ahead. It is not linear. There will be days when the market makes no sense. There will be days when you do everything right and still lose money. That is the cost of doing business. The difference between the 90% who fail and the 10% who succeed is not that the winners never lose. It is that the winners have a protocol that prevents a bad day from becoming a bad life. They treat trading as a business of probability, not a game of certainty. You now understand the battlefield. You know that futures offer transparency, tax benefits, and centralized volume, but demand rigid discipline and higher capital. You know that Forex offers flexibility, microsizing, and global access, but hides costs and spreads and operates in a decentralized fog. There is no best market. There is only the market that fits your mind, your wallet, and your lifestyle. The choice is now yours. Will you step into the arena as a gambler, hoping for luck? Or will you step in as a professional, armed with the knowledge of market structure, the protection of risk protocols, and the clarity of a defined plan? The market is waiting. It is indifferent to your success or failure. It will simply offer you a price. What you do with that price will determine your future. This concludes our deep dive masterclass on market structure. But understanding the structure is only the foundation. The next step is understanding the specific tactical strategies that extract money from these structures. We need to talk about auction market theory. We need to talk about supply and demand zones, not as lines on a chart, but as pockets of liquidity. We need to talk about how to read the tape. If you are ready to move from understanding the stadium to playing the game, if you are ready to learn the actual setups that professionals use to exploit these market mechanics, then you know what to do. The next series is already in production, and we are going to go even deeper. Prepare your charts. Class is dismissed.